Dan Zanger is known for one of the most legendary runs in trading history, turning $11,000 into $42 million during the late 1990s dot-com boom. But could he do it again today? Could anyone? This question cuts to the very core of what it takes to succeed in the modern market, a landscape vastly different from the one Zanger conquered. The internet bubble was a once-in-a-generation event, a period of unprecedented speculative frenzy where tech stocks with little to no revenue soared to astronomical valuations. It was a gold rush, and Zanger was the ultimate prospector, armed with an encyclopedic knowledge of chart patterns and an iron will. He famously analyzed thousands of charts by hand, memorizing the subtle signals that preceded massive breakouts. His strategy wasn't complex. It was brutally effective. He bought stocks breaking out of specific chart patterns, like high, tight flags, and sold them the moment they showed signs of weakness. This approach, while seemingly simple, required a level of discipline that few possess. The market of the late 90s rewarded this aggressive, momentum-based style, as the upward trajectory of tech stocks seemed limitless. It was a unique alignment of a specific strategy with a perfect, once-in-a-lifetime market condition. The question of whether this feat could be replicated today isn't just about the numbers. It's about understanding how the very nature of the market has evolved and what timeless principles of success remained. His success wasn't luck. It came from years of studying charts, spotting patterns, cutting losses quickly, and letting winners run. Before his historic run, Zanger spent over a decade honing his craft, suffering significant losses, and learning hard lessons. He wasn't a Wall Street insider or a quant genius. He was a pool contractor who became obsessed with the language of the market charts. He believed that every piece of fundamental information, every news event, and every shift in investor sentiment was ultimately reflected in price and volume. His method was a masterclass in risk management. He operated with a strict rule: never let a loss exceed 3 to 5%. This ruthless approach to cutting losers protected his capital, allowing him to survive the inevitable wrong calls and stay in the game long enough to catch the explosive winners. While others were paralyzed by fear or greed, Zanger executed his plan with mechanical precision. He let his profitable trades run, sometimes for weeks or months, as long as the chart's technicals remained strong. This combination of swift loss cutting and patient profit taking is the holy grail of trading. Yet it is what most traders fail to implement. His success was not a fluke or a lucky bet on a hot sector. It was the result of a meticulously developed and rigorously executed system, forged through years of obsessive study and painful trial and error. The key lesson: trading success depends less on a perfect system and more on discipline, psychology, and timing. Many aspiring traders search for a flawless indicator or a secret algorithm, believing that the right formula will unlock guaranteed profits. Zanger's story shatters this myth. His system of chart patterns wasn't a secret. These patterns are described in countless trading books. What made it work was his unwavering discipline to follow his rules without exception. He had the psychological fortitude to buy at new highs when most feel it's too expensive, and to sell immediately when a position turned against him, even if it meant admitting he was wrong. This emotional control is far more valuable than any technical indicator. Furthermore, his timing was impeccable, not by chance, but by design. He didn't just trade any market. He recognized that the dot-com bubble was a unique environment ripe for his specific strategy. He waited for the perfect wave and then rode it with everything he had. This illustrates a profound truth. A good trader with a mediocre system will often outperform a bad trader with a brilliant system. The difference lies not in the what of the strategy, but in the how and when of its execution, the domain of psychology and market timing. Zanger's achievement was tied to a unique market environment, the internet bubble. If he started in a flat or algorithm-driven market today, repeating those exact results would be nearly impossible. Today's markets are a different beast. They are dominated by high-frequency trading HFT algorithms that can execute millions of trades in a fraction of a second, often exploiting the very patterns that retail traders like Zanger once used. The information flow is instantaneous, and the edge from simply reading charts has diminished. The market of the late 90s was characterized by a widespread, almost naive, bullish sentiment. Today's market is more cynical, more complex, and fragmented. A flat, range-bound market would offer few of the explosive breakout opportunities Zanger's strategy requires. An algorithm-driven market would see his entries front-run and his stops hunted. The sheer volatility and momentum of the dot-com era, where stocks could double in a week, are not the norm. To achieve a 381,000% return today would require not just skill, but a systemic anomaly on the scale of the internet bubble, which simply does not exist in the current, more mature, and heavily institutionalized financial landscape. The game has changed, and the rules of engagement are far more sophisticated. Still, what set him apart was his mindset, mental toughness, patience, and the ability to act decisively under pressure. These traits would allow him to succeed in any market, even if the numbers looked different. While the $42 million figure is what grabs headlines, the true essence of Zanger's success lies in his psychological framework. This is the portable, timeless skill. Mental toughness is the ability to take a string of losses without losing your confidence or deviating from your plan. Patience is the discipline to wait for the perfect setup, sitting on cash for weeks or months if necessary, resisting the urge to do something. And decisiveness is the courage to pull the trigger without hesitation when that setup finally appears, and to exit just as quickly when the trade sours. These qualities are market agnostic. A trader with Zanger's mindset dropped into today's market would not try to force his old strategy. Instead, he would do what he did in the 90s, study the new environment obsessively, identify its unique characteristics, and adapt his methods to exploit its new patterns and inefficiencies. He might not turn $11,000 into $42 million, but his mental resilience and adaptability would undoubtedly make him a consistently profitable trader. The numbers on the P&L statement would change, but the core driver of his success, his mind, would remain a powerful asset. Many traders fail not because they lack knowledge, but because they can't master emotions like fear, greed, or overconfidence. The average trader spends 90% of their time searching for the perfect strategy and only 10% on their own psychology. The successful trader inverts this ratio. Fear causes traders to sell winners too early and to be paralyzed from taking a valid setup after a loss. Greed compels them to over-leverage, chase trades, and hold on to losers in the hope they will turn around, leading to catastrophic losses. Overconfidence, often following a winning streak, leads to sloppy executions, breaking rules, taking on excessive risk, which is often the precursor to a major account blow-up. These emotional pitfalls are the true destroyers of trading accounts, far more than a bad strategy. Knowledge of technical analysis or fundamental valuation is widely available, but the ability to remain calm and rational when your own money is on the line, when the market is moving violently against you, is a skill that cannot be read in a book. It must be forged in the fire of experience, self-awareness, and relentless discipline. Zanger's story is a testament to this. His mastery was not over the market, but over himself. Legendary trades throughout history, from Jesse Livermore to George Soros, all happened in unique moments, but the common thread is their ability to manage psychology. Jesse Livermore, the boy plunger of the early 20th century, made and lost several fortunes, most famously by shorting the market before the 1929 crash. His success came from his intuitive feel for market dynamics and his courage to take massive, contrarian positions. George Soros broke the Bank of England in 1992 by betting against the British pound, a trade rooted in a deep macroeconomic understanding and the conviction to risk billions on his thesis. Paul Tudor Jones made his name by predicting and shorting the 1987 crash, a feat of timing and psychological nerve. Each of these legends operated in a different era with a different strategy. Livermore was a pure tape reader. Soros is a global macro investor. Keynes combines technical analysis with a macro view. Hey, their methods were context dependent, but their mindset was universal, an almost preternatural ability to manage risk, handle immense pressure, and act with conviction when others were frozen by doubt. Their stories reinforce the idea that greatness in trading is not about a single, repeatable formula, but about a superior psychological operating system. For modern traders, the real takeaway isn't chasing Zanger's 42 million record. It's about building the mental resilience to survive, adapt, and grow over the long run. The allure of get-rich-quick is a dangerous trap. Fixating on Zanger's multi-million-dollar return sets an unrealistic and counterproductive goal. It encourages a go big or go home mentality that almost always leads to going home. The real lesson is in his process, not his result. The goal should be to emulate his discipline, not his P&L. This means focusing on the unglamorous daily habits of successful trading, rigorous preparation, strict risk management, meticulous record keeping, and constant self-review. It's about developing the mental fortitude to endure the inevitable drawdowns and the humility to learn from every mistake. Survival is the first and most important objective in trading. Only by protecting your capital can you stay in the game long enough to gain experience, adapt to changing markets, and allow the power of compounding to work for you. The journey is a marathon, not a sprint, and mental resilience is the fuel that will get you to the finish line. Trading is ultimately a psychological battlefield. If you master your emotions, you give yourself a fighting chance. The market is a mirror that reflects your own internal weaknesses back at you with ruthless efficiency. It will exploit your fear, prey on your greed, and punish your arrogance. Every click of the mouse is a decision point, a test of your discipline and emotional control. The endless stream of financial news, social media chatter, and fluctuating prices is designed to provoke an emotional reaction to pull you away from your plan. The battle is not you against the market. It is you against yourself. The external noise is just a distraction. The real work is internal, cultivating patience, enforcing discipline, and maintaining a state of objective, rational calm in the face of uncertainty and chaos. This is the final boss of trading. You can't control the market. You can't control your reactions to it. Mastering your own psychology doesn't guarantee you'll make $42 million. But it is the only thing that gives you a legitimate shot at long-term success. Without it, even the best strategy in the world is worthless.